Great. I think we're ready to get started. I hope everyone's settled. Good morning or good afternoon. And I'd like to thank everyone for joining us. My name is Rob Manser, and I'll be moderating today. We're joined by Jeff Groh, our CEO and founder, and he'll be sharing his insights and expertise around sales and use tax. As well as we'll talk about how you can improve tax compliance through data quality. Sales tax calculations are becoming exponentially more complicated due to changes in state legislation around Nexus, product categorization, and the endless overlays of new tax districts. As part of our presentation, we'll discuss how data quality tools like Service Objects, DOTS Web Services can provide solutions for examining data points that are required to maintain sales and use tax compliance. We have about 20 slides to share, and we'll do our best to answer questions as we go along. So please feel free to chat them to us as we're talking. But before we begin, let me start with a little housekeeping and share our obligatory disclaimer. This webinar is for informational purposes only. Be advised that sales tax rules and laws are subject to change at any time. For specific sales tax advice regarding your business, contact a sales tax expert. At the end of the webinar, we'll also provide a link for a replay of the webinar. So what can you expect today? One, we'll go over a brief history of sales tax. We'll talk a little bit about online sales statistics and the tax revenues generated by source. We'll talk specifically about sales taxes by state and how they differ. And then we'll go into geocoding for tax rates and why that's so important. We'll talk about a little bit about inaccurate tax rate examples. Some of them are kind of fun. Tips to improve compliance. And lastly, we'll leave a little time for questions. So to get started, let's turn it over to Jeff here. Jeff?
Good. Hey, thanks very much, Rob. I thought I'd start with this slide. This is probably the most popular story of unhappy customers due to tax rates. This is the Boston Tea Party story. And just to remind everyone, back to third grade, in December 1773, a group of Massachusetts colonists dressed as Native Americans and boarded 3 British ships anchored in Boston Harbor. These colonists believed that England was imposing too high of a sales tax on tea and took it among themselves to dump 342 chests of tea, about $1 million in today's dollars, of tea into the water. It was called the Boston Tea Party. Every third grade student learns about this story, and it all happened because of too high a sales tax imposed by England. Sales tax is defined as the tax collected by a seller when the final sale in the supply chain is reached. Tax authorities do not receive this tax revenue until the final sale occurs. The American tax system is unique in that retailers are expected to collect all the taxes required by state and local governments. The American system is also unique because it does not have a federal component to its rates like in many countries. States are free to set their own sales tax rate. Other countries like Canada do have goods and services tax, but these are federal levied taxes on most goods and services. However, the American system does not have federal goods tax. The first sales tax in the United States was enacted in the state of Mississippi in 1930 in response to failing property tax revenues that were happening during the Great Depression. It made sense at the time because many properties were going into foreclosure or bankruptcy, or people failed to pay their property tax. So the state of Mississippi needed to enact sales tax because their economy was predominantly based on the transactions of goods rather. But since then, so much has changed, primarily in the way that we buy goods as a consumer. This next chart shows online commerce and mail order sales in the United States. Last year, Americans bought $370 billion worth of goods from online retailers. Online sales are skyrocketing, but the technology needed to collect tax is not. Most merchants today, when it comes to taxes, most merchants today point to a 1992 Supreme Court ruling in the case of Quill versus North Dakota that said Mail order retailers are not required to collect sales tax in any states, partly because of the complexities of doing so. In that landmark decision, the Supreme Court ruled that residents do owe taxes for their out-of-state purchases, but that those states could not force companies to collect the money because it was too complicated and too burdensome. However, since that 1992 ruling, a lot has changed, and states have begun to pass laws that run counter to the case. And everyone expects soon, or everyone expects the Supreme Court soon, to review and overturn its 1992 decision, and to soon pass laws that will put the burden on online companies to collect sales tax in all states. According to a recent Aberdeen study of 262 tax professionals, 97% of respondents have experienced a tax audit in the last 5 years. 57% of the respondents have identified inaccurate rate data as one of the leading risks facing their business today. This year, CSI Market came out with another study that said organizations in the mid-market, that means organizations with 250 million revenue to 500 million revenue, when audited, on average, have been assessed fines of up to 2% of their overall revenue. And that is a huge number to be audited for sales tax and use tax compliance and have a 2% penalty on top of your already slim margins. It's huge. Keep in mind, the average profit or the average net income of an internet, mail order, or online shop is only 2.9%. So a 2% penalty is significant. It can really make the difference between a profitable year and really a terrible year or a year with a loss. Nonetheless, states need this income. It's among their largest source of income. On average, across the 50 states in Washington, D.C., 34% of their revenue, of a state's revenue, is derived from sales tax. 35% is derived from property tax, and 20% comes from income tax. Specifically, every state is different, and every state has its own recipe, so to speak, of how it generates its income. For example, here the sales tax ranged from almost 9% in Washington state to Oregon that has no general sales tax at all. In this map on the screen, the darker the blue area, the higher the sales tax rate. Each state has its own recipe for tax revenue based on its own philosophy. If I show this map as a graph, and I know it gets a little confusing, but the state with the highest portion of tax revenues from sales tax is Washington state, with over 60% of its revenues derived from sales tax. After Washington, states that also rely heavily on sales tax are Tennessee, Louisiana, South Dakota, and Arkansas. These are shown towards the left-hand side of that chart. Oregon is a state that had the smallest portion of state local taxes. And also, the other four remaining are Alaska, Delaware, New Hampshire, Montana, as well as Oregon. Those four states, Alaska, Delaware, Montana, New Hampshire, and Oregon, don't have general broad-based sales tax, but they do have selective sales tax for items like alcohol beverages or amusements or insurance, gambling, fuel, public utilities, tobacco. Said another way, or said again, states on the left side of the chart have the highest tax rates. Sales on the left side of the chart have the lowest tax rates. I want to make sure I got this right. Sales on the states on the states on the left side of the chart have the highest tax rates, and states on the right-hand side of the chart have the lowest tax rates, and each has its own recipe. To fully understand this sales tax and use tax, or sales tax as a revenue, you also need to understand sales and use tax. Sales tax is collected by the buyer for I'm sorry, you're right. Thank you, Rob. Sales tax is collected by the seller for an in-state purchase. Use tax is paid by the buyer for an out-of-state purchase. The use tax is imposed on the buyer of a tangible personal property that is used on a different state. Consumer use tax applies to purchases from out-of-state vendors when they are not required to collect tax on their sales. Sales tax and use taxes are mutually exclusive, which means that either sales tax or use tax applies in a single transaction, but never both. For example, I live in California, and when I buy something here, a physical merchandise, I have to pay the sales tax would apply. However, use tax applies when I make a similar purchase without paying the tax from a business located out of state. For these purchases, I am required to pay use tax separately. Usually this is self-reported. However, in some states such as Oklahoma and Colorado, they're forcing online retailers to report sales information so they collect use tax from the buyers. In most states, use tax and sales tax are identical. They're identical rates, but not always. Another key element to sales tax compliance is nexus. The word nexus is Latin, meaning to bind, join, or tie. A business with sufficient presence in a tax jurisdiction has nexus. That's a little vague, and I understand that. And businesses have spent 70 years trying to figure out what sufficient presence means. In general, a sales tax nexus occurs when your business has some kind of connection to a state. All states have slightly different definition of what nexus means to them, but most of the time a state considers a physical presence to cause nexus. Sufficient presence can mean a number of things, including having an office in another state, having an employee, having a warehouse, having a reseller, or storing inventory in another state. Even temporarily doing business in a state for a limited amount of time, such as a trade show or a craft fair, may also cause nexus. Determining where your business has nexus can be complicated and time-consuming. Many states have changed their definitions of nexus in the last few years, so it's important to stay up to date with recent legislation. For example, or one of the biggest changes is that in the last 5 weeks, Amazon has started to collect taxes or tax deliveries on all 50 states, plus the District of Columbia. Amazon's decision does not mean that other merchants now have to collect taxes. Even though Amazon has decided to collect taxes nationwide, nexus rules still apply. Again, a business only has to collect sales tax when it has specific connection to that state, such as an employee in that state, or inventory, or infrastructure. Other online retailers, such as eBay, are adamantly opposed to collecting taxes where they lack nexus. Dropshipping can be very convenient for the seller and the buyer, but can really complicate sales tax. And this is something I wanted to mention. For example, I had mentioned earlier that Washington State has some of the highest tax rates, and Oregon has some of the lowest sales tax rates. Mattress World is located on the Oregon-Washington border, and many Washington residents would come across the state border to pick up a mattress from Mattress World, and then they started offering delivery and setup service to their Washington customers, even though they were located in Oregon. But by hiring and sending that vendor across state lines, Mattress World created nexus under Washington's tax code. The company didn't really plan for this and ended up with a $2 million penalty in the state of Washington. So if you're using a drop shipper or a fulfillment house, you've probably created enough presence to have nexus in that tax jurisdiction. Most consumer goods like mattresses and products are easy. They are taxable, but a lot of weird rules still exist. And there's some effort to get this unified. In some states, Kit Kats and Whoopers are not candy. They're considered food, believe it or not, because they contain small amounts of flour. The state of Pennsylvania does not, in general, tax clothing, but it does tax fur articles. Well, only some fur articles, and it's not really clear. In Pennsylvania, a wool sweater is tax exempt, but a coat with fake sheepskin trim is taxable. Indiana categorizes marshmallows as candies, which is taxable, but marshmallow cream as food, non-taxable. North Carolina categorizes stuffed olives as prepared food, taxable, and unstuffed olives as just regular food, no tax. The state of Texas and the state of Connecticut have rules that tax certain snack treats differently based on the size of the container. So a large container might be tax-free, but a single serving container might have taxes, which is certainly odd. In Texas, the portion of a contractor invoice, if it's a new home, it's tax-free. If it's a remodel, it has taxes. In California, and this is a strange one, certain types of wood fencing is tax-free. However, metal fences in California are always taxable. And this is just the tip of the iceberg. Circling back on taxes, and I mentioned it before, taxes are set up at the state level. That's part of our agreement with the federal government. And I mentioned that, and it's well, sort of. As you remember earlier, the darker states have the greatest taxes, and the lighter or the gray states have no taxes at all. But if you read the fine print on here, it says this is all right except for city, county, and municipal rates may vary. So I lied. I really didn't take into consideration city, county, and special municipalities. To say that California has a tax rate of 8.25% everywhere is wrong. There are 58 counties in California, shown here, and most of these counties have special rules on their cities within. This tax rate applies to incorporated areas or incorporated cities within these areas. So, for example, the county of Monterey, California, or the county of Monterey, has roughly 12 or so special tax areas. They are the city of Carmel, the city of Delray Oaks, the city of Gonzales. You can see they have a supplemental tax in those cities. That tax only applies in the incorporated areas of those cities. So if you should live in Carmel by the Sea, but in an unincorporated area of Carmel by the Sea, your tax rate would be 7.75. But if you lived in the incorporated area, it's 8.75. Some of these cities also have special districts within the cities, not shown here, like a tourist rate or a special stadium that they might be building. They have additional sales tax, again, not shown here, but occur in California. All in all, we've been able to find 100,000 combinations of these state, local municipalities in the United States. And the key point here is that even though these tax rates are applied at the city level, it's important to determine if the address that you're shipping to is in the incorporated portion of the city or the unincorporated part of the city, because as you can see, the tax rates will vary quite a bit. To further complicate the matter, some states allow counties to set their own tax rates, and some counties then allow cities to set their own tax rules, and then some cities have special jurisdictions, and those jurisdictions, the boundaries are not always clear. Accurate tax calculations today need to be geocoded, and they need to be address validated. Getting business from a new area in town could mean that you owe a completely new tax rate. You can have a completely new tax rate for sale to that area and have to pay taxes to a different authority. Colorado is notorious for this. For example, in one zip code, they can have up to 6 different tax rates. Most tax providers or tax rate providers are only looking at the city-state, or maybe if they're advanced, maybe they're at the zip code level. But zip code rates no longer work. The tax layout, the tax schema has become far more difficult. So each address that you're shipping to, or your buyer's address, needs to be validated and geocoded, and the tax calculated accordingly. Here in this example, again, there's 6 different tax rates in this one zip code. But if I zoom in, zoom in on this the existing map, you can see that an address on the north side of 52nd Avenue has a tax rate of 4.5%, and an address on the south side of 52nd Avenue has a tax rate of 7.62%. Now remember, this is in the same state, the same city, and the same zip code, but there's quite a large, over 3% different sales tax rates just on both sides of the street, even though they're in the same state, the same city, here Denver, and share the same zip code. There are deep financial impacts for failing to properly calculate sales tax, including potential fines and class action lawsuits. So what can be done, or what has been done? With these compounding issues of Nexus, or the complexity of Nexus, the weirdness of product types, and the proliferation of rates, what's a company to do? Because the states need this sales tax, and ta-da, the federal government to the rescue, or sort of. They have a new system, a new resource called Streamlined Sales Tax Project. Their goal is to simplify sales tax and use tax, the collection of it, and encourage states to adopt a uniform set of products and a uniform way of providing sales tax. Because if it's simpler, it would be easy for all states to collect. Again, their mission to assist states as they administer a simpler and more uniform sales tax system. And it was first set up in March of 2000, and again, the idea here was to modernize sales and use tax and the administration of it in the United States. However, after the last 17 years, there are still 2 very large fundamental problems with the Streamlined Sales Tax Project. Only about half the states provide data from it. You can see our state, Colorado, there does not participate at all. And not every state charges sales tax. Also, it requires their database and the data that they provide, it requires that you have a valid ZIP+4 value for each of your customers. Well, that's a very difficult lookup. I know my zip code at home is that 93103, but I don't know, or I'm one of the few people who know that my ZIP+4 value is 93103-2013. So it only provides half of a solution, half the data, and it requires, the database requires a ZIP+4 value for accurate lookup. So companies today are still stuck with relying on IT to make tax rate updates on homegrown, cobbled together systems that really handcuff tax professionals to stay current with changing tax rates and changing jurisdictions. But there are solutions, and there are online solutions that help bring that data to the forefront and into applications and ERP systems and point of sale systems. And here are some of the tips that we have for you to improve your sales tax compliance. Our first tip would be to know your nexus. This is really important, to know where you have sufficient presence and where you're obligated to collect tax. This is a very important thing. Number 2, know how you drop ship. Do you use drop shippers? Do you use a fulfillment house? Do you have a warehouse in a different state that stores your product? Also, know your SKUs. Are you selling clothing, candy, food, or certain home improvement items? You should know which items are taxable and which items aren't. Number 4, validate every address every time. It's important to know the exact location of your customer, which city are they located in, which county are they located in, and if they're located in any special tax districts. It's important as well. And use a geocode-based tax rate table. Not a zip code table, not a state city table. You need to be looking at these addresses individually to get their accurate values. Companies that are using zip code tables only are not getting the full picture and can get into trouble. The last 2 is follow what Amazon does, especially with regards to Nexus. This last 5 weeks, where they're now collecting sales tax in all the districts, in all the states, and in Washington D.C. is of quite interest. And finally, keep up to date with the Streamlined sales tax projects. Although it's 17 years old, they are making good progress on trying to get the states to unify product categorization. So hopefully in the near future, products will have a unified type of category, whether it's taxable or not taxable. Service Objects does an awful lot of data quality. We validate addresses, we provide address geocodes, we validate phone numbers, and a serious decision white paper came across my desk, and I love this quote. It's their 1-10-100 rule. What they say is that it takes $1 to verify a record as entered. It takes $10 to cleanse it and dedupe it, and it's $100 if nothing is done, as the ramifications of the mistake, here data quality, are felt over and over and over again. So I would like to charge and put forward a new rule, the new 1-100 or the new 1-10-100 rule that says, and apply it to tax rates. It only takes about a penny to verify a tax rate at the point of entry. But if that tax rate is found to be incorrect, it costs $10 in a tax audit. It costs $100 if it becomes a customer service issue, as the ramifications of that bad tax rate are felt over and over and over again. Consumers know their tax rates, and we are seeing more commonly where merchants are coming to us looking for tables because they're having not only sales tax audits due to incorrect tax rates, but also customer service issues due to incorrect tax rates. So with that, I'd like to close and open it up for questions.
Sorry,
and
Jeff.
hand it back to you.
There were a couple questions that came in. I just didn't interrupt you in time. So let's just go back and look at them. We talked a lot about the U.S. How are sales and use tax different in Canada or internationally?
Well, you know, the internet. I'm not too familiar with international taxes, and I know we don't cover those. But in Canada, they do have a GST, goods and service tax, applied at the federal level. I believe that it's about 6%. Then each province then applies an additional tax of a couple percentage points on top of the purchases of goods and services. Our system does track Canadian tax rates, the GST and the PST, and does provide some additional information. But their tax system is a little different than ours because they have the federal component of the tax rate, where we have just the state component.
Great. The next one, how often should I check to see if a tax rate has been changed?
Well, you know, we're updating the, I would suggest if you're going to store the tax rates and another event or another transaction occurs, you should be looking in the tax rate tables quarterly for updated rates. That's how often we're updating the tax rate data. So I would suggest no longer than every quarter.
Okay, great. What point of sale systems does your tax service interface with?
Well, we do have plugins for Drupal and a few of the other online shopping carts. We also provide a web service API, an XML or a JSON interface API that allows developers to get raw access to the sales and tax rate data.
Great. Sorry. How often? This is a little bit different, I think. How often is your tax data updated?
Well, it's as I mentioned before, the tax data is updated about once a quarter. The map data is updated, or the jurisdiction data is updated about once a year, and the address data, where new addresses come in and out, is updated every 2 weeks. So I would probably say the tax data, because accurate tax lookup is dependent on knowing the address, knowing the map, and having the proper tax rate. I would say we are updating our tax rate data every 2 weeks.
2 weeks. Yeah, I think that's true. Great. That's it for questions, I think. I'd like to thank everyone for attending. I think the key points that we can take away from here is you need to know your nexus. Do you have sufficient presence, and are you obligated to collect tax? Again, of course, how you dropship and do you use dropshippers is something to pay attention to as well. The mattress world is a great example of that. And validate every address every time, and know your customer's location, not just their zip, but you need to actually need the geocoded at the geocoded level. And that way you can use the geocoded based tax rate tables and not zip code tables to look up the correct tax rates. So that's it for our presentation. If you have any questions, please feel free to call us. We do offer our DOTS FastFacts web service, and as Jeff mentioned, it's updated quarterly, but the address validation data is updated every 2 weeks. So that combination, that powerful combination, helps you stay current. We also have a white paper that you're welcome to download on the website, and at the end of the webinar, we'll put together the presentation and make it available online for everyone. So again, thank you everyone, and look forward to talking to you soon.
Thank you.